What's going on, guys? Today we're going to be taking a look at Bitcoin. Before we do, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So it's been a while since we did a deep dive on Bitcoin, so I figured what better time than today. But instead of looking at the spot market, we're going to go ahead and look at futures. And I know what you're thinking. Isn't Bitcoin futures just Bitcoin for boomers? And Bitcoin is kind of already the boomer coin, so it's sort of like boomer inception or like boomer squared. And the answer is yes. But because those boomers have a lot of money and they tend to represent the institutions, it's worth having a look. And the reason we're looking at the futures chart today instead of the spot market is sometimes there's differences because obviously the futures market closes on Fridays and reopens on Sunday evenings, so it's closed over the weekends, and sometimes that can cause divergences between the actual chart of Bitcoin spot market and futures market. Not to mention, when we use things like moving averages, the look back period for 200 periods, say on the daily for the Bitcoin futures market is going to look substantially different when you're only looking at 5 days per week compared to the Bitcoin spot market, which you would look at 7 days per week. So that 200-day moving average is going to start cutting out important stuff that took place a while back. So we're seeing a pretty big divergence now with those moving averages between spot market and futures market. So we're going to focus in on futures and what the institutional money is probably seeing. And I know what you're thinking. You already knew all that stuff. So why do I keep reiterating on the same points over and over again? And you're right. I'll probably go through and cut this out. There we go. I edited out a bunch of stuff about the meaning of life and how to be a successful trader and all that stuff because I figure you knew that too. All right, enough lollygagging around. Let's take a peek under the skirt of the old Bitcoin futures chart and see what she's hiding. Is it the coveted golden ticket for success or the smell of sadness and defeat? So here we got the Bitcoin futures chart on the daily. And as you can see, we went into a very powerful uptrend back here from about 8,500. And then we double topped out here. And then we've come back down. And we've very clearly been in a bear market for the last year or so. Now, if we zoom in here a little bit, we can see now that some important stuff is starting to happen on the futures chart. We actually bounced back up and retested the 200 simple and then also the 200 exponential moving average. And the 200 exponential, the red moving average, has actually started to flip over blue. Now there's two things that we can pay attention to specifically when we're looking at these moving averages. It's not only the slope of the moving averages, they're obviously pink and red when they're in a downtrend or pointed down, and then they turn blue when they're pointed back to the upside, but also the posture of those moving averages relative to each other. So if the 200 exponential moving average is on top, the trend is strong if we're going to the upside. If it's on bottom, it's strong if we're going to the downside. So when this cross took place right here and the 200 simple crossed below the 200 exponential, that means that the trend is losing strength to the downside. And that's typically what you want to see when a market is bottoming. So that's definitely worth paying attention to. And then if we zoom in here a little bit, we can see actually that the 200 exponential has basically a flat slope and it's actually flipped a couple times between red and blue. So that's the beginning of potentially having a positive slope and going back into a bull market. The 200 simple is going to lag a lot further behind, so the slope is still pretty aggressively to the downside, and that would take quite some time. But as long as we're on top of both those moving averages, particularly the 200 simple, it will eventually roll to flat and then curve back up as well. And at that point in time, we're likely to be entering into a potential bull market. So that is obviously the bull case, what we want to see happen here. Unfortunately, we bounced up here recently and we're basically a couple minutes away from closing our daily futures. And we're at that level to lose the 200 exponential. So as long as we're between the 200 exponential and the 200 simple, while this is weakness and it's not great that we couldn't hold this level, we're still essentially neutral on the market because we're basically trapped inside that range. So right now the 200 simple is going to be moving to the downside, but it's at 21,240 and the 200 exponential is basically flat at 23,600. So what I expect to happen is we're going to bounce around and test those ranges, the top and bottom of the range, until eventually either the bulls are strong enough to break us out to the upside and potentially start that bull market, or the bears are strong enough to break us back to the downside and retest those potential lows or continue in the bear market. So we don't really know what's going to happen right now, but we have a very clear area at 23,600 and a very clear area at 21,200. So about a $2,000 range right there that we would expect price action to bounce around inside of. Now, another thing to pay attention to is our futures gap right here. So we're going to turn on our drawing tools for a second. So what we were talking about earlier with futures and spot market, obviously futures is closed on the weekend. So sometimes if we have an aggressive move either to the upside or to the downside, we'll leave a gap behind. And essentially all that is is just a difference from when we close price action on a Friday and when we open price action on the following Sunday. So in this case, we have a pretty big gap. It goes from essentially 19,500 all the way up to 20,750. Gaps, much like moving averages, tend to act like magnets, pulling price towards them or pushing it away as it approaches. So think about the polarity of a magnet when you try to put something towards it. As it gets closer to the magnet will either pull it closer until they touch, or vice versa. If you have it reversed, as you push it and it gets closer and closer to the magnet, it will more aggressively push it away. So think about the moving averages and the gaps as magnets that are either pulling or pushing price action away. So in this case, if I'm correct and we just continue to move inside these moving averages, just kind of bouncing around from the top to the bottom, it's worth noting that the 200 simple moving average is very, very close to that gap. So should we come down to that area, think about the gap as an air pocket, where if we get into that air pocket, there's nothing really holding us up, and we'll likely fall down to the beginning of the air pocket or where we gapped from. So that is called closing the gap, and statistically speaking happens very, very often, so it's worth paying attention to. What you don't know is when that gap is going to get closed. Sometimes it can take months, years, and other gaps never get closed. So while it's not a certainty that that would take place, it's worth watching because we could see a series of events where we suddenly drop from 23,500 down to 21,200 and then actually end up back down here at about 19,500. And while it might look bad at the time and scare people into exiting their positions, it's not necessarily a bad thing. The most important thing we want to pay attention to is just putting in another higher low. So anytime we come back down here, as long as we don't take out the macro lows from back here, it's actually going to be bullish. So we talked about the divergence between the moving averages and the differences between the spot market and futures market, as well as the gap down here. All that stuff is fairly bearish, but actually on the macro, if we really zoom out, we would be kind of holding this long-term trend line right here. So it wouldn't be so bad. We'd be reclaiming the 200 exponential and simple moving averages. So that's good as well, and potentially continuing to the upside. So here we're looking at our futures chart for the entire life of futures on the daily. And we have two different Fibonacci's in place. We have the green representing the macro low back here at 3,100 in 2018, all the way up here to the macro high in 2021 of about 70,000. And then we also have the Rona low right here from March of 2020 at about 4,200, all the way up to the macro high as well. And oftentimes we will see the bots, the algos, the whales, market makers using one or both of those key swing lows. So in this case, I like to look at both of them the same way I look at the 200 exponential and simple moving average. I like to look at the swing low and then also macro low as well. So when we put in the high, we came back down and actually touched the 236 on both of our Fibonacci's, essentially confirming that the top is in. At that point in time, we pushed up, we put in a lower high, and we lost the 200 moving averages, which is represented by these purple circles. So if we zoom back in for a second, we can see here they flip both bearish, and then we actually flipped them back positive for a second, saying that there was potential the bull market might resume. And then actually shortly afterwards, we broke down from that, and we've been in a bear market ever since. And now we're very close to flipping those potentially back blue again. Now it could turn out to be a situation like this where they flip back blue, it fails, and then we go back into a bear market. Or it could be a situation like this where it's the beginning of a new bull market and we're about to go up by hundreds or even thousands of %. So we don't want to rule out either one of those scenarios, but in the meantime, we are still technically in a bear market. So once we broke down to the 236s, we came up, we put in that lower high and lost the 200 moving averages, went into that bear market. We fell pretty aggressively. And when we did, we came down to both of those 382 levels, kind of bounced around in that level, and then broke down again right in between the 0.5s for both of those levels as well. So we're seeing some pretty clear interactions with both fib levels, and it's worth watching them both for now. Once we came back up here on this most recent rally, we essentially got above the green 382, and now here we are at the white 382. So again, those are key levels, and those two levels happen to correspond as well with the 200 exponential and simple moving averages. So that little channel that we were looking at when we were zoomed in here, now that we have a greater view, the white 382 is actually also the 200 daily moving average exponential, and then the 382 in green here is also the 200 simple daily moving average. So it's not crazy to think that we might actually just kind of bounce between not only the moving averages, but also those Fibonacci levels as well. And then if we were to lose this level or test down too aggressively, we might come down and close that gap. So that's the situation we initially talked about. An alternative situation would actually be if we came back down here, bounced around, found some support, and then came back up, and then actually just broke out and continued to the upside, and then flipped both of these moving averages blue and saw resumption of the bull trend. So if we just zoom back out here and look at the macro, what does that really mean? Well, if we're at the 382 and we bounced off the 0.5, oftentimes you'll have something called a 2 fib level bounce. So we basically come down to the 0.5, we bounce back up to the 382, and then again to the 236. So in my opinion, the next target to the upside for a potential bull move, whether it's a bull market or just a bounce, is right around the retest of the 236s. So that would be a potential target to the upside and somewhere where I might want to be taking profits. That's also a very clear resistance line from previously support that now we would expect if we retest would act as a very, very hard zone to get past, as a lot of people are trapped in positions above that level. So there would tend to be high levels of selling pressure. We also have that long-term ascending blue support or resistance line that corresponds with those 236s also. So this is a key level I'm looking at right here from about 31,400 to about 35,000. And that would be our potential upside target if we see a breakout above these levels from either where we're at now or even from lower targets. And that could give us potentially a move to the upside of 35 to 50% on Bitcoin. Now, what about that bear scenario that we talked about? If we come back down and close the gaps, and then potentially if we bounce back up off the 0.5 only to the 382, and then actually just went to our next lower fib to the downside. So if we use the same drawing tool from where we're at right now, just coming down to the bottom of the range and retesting the green 382 is about 11.5%. If we come down lower and close the gap, that's about 17%. And then if we actually come all the way back down and retest the lows at the 0.5s, we're talking about 37%. And then if actually we lose the lows and put in a new macro low, we would be looking at the 618 in white or the 618 in green. The 618 in white would be down 48%. And the 618 in green would be down 57%. So we'll go ahead and just zoom back in here a little bit. And I want to just put a trade setup in play and just essentially show what I'm looking at right now. So if our target to the downside is going to be the white or green 618, and we just put this right smack in the middle, and our target to the upside is going to be the white or green 236, we'll just put it smack in the middle there as well. And then if we just look at the trade setup, we're looking at potential downside target of 52%. We're looking at potential upside target of 44%. So there's no real benefit at this point in time. The risk reward is close to 1-to-1. So there's no real trade setup that you could look at on long term with an attempt to the next target, because we're basically smack in the middle right now. So if you're not sure if it's going to go up or down, and it's basically a coin toss, and the risk reward is essentially 1-to-1 as well, you don't really have an advantage on the market right now, and you're basically just gambling. So while there may be some shorter term trade setups for downside or upside targets, right now the main trend and the macro that we're looking at essentially is a coin toss and 1-to-1 risk reward ratio. So there's no real benefit right now. Typically what we're looking for is at least 2-to-1 risk reward ratio if we're trading with the trend, or 3-to-1 risk reward ratio if we're trading against the trend. And right now it's kind of a toying cost because we're in between the 200 exponential and simple moving average. One is blue and one is red. So it's essentially mixed signals. There's no real directional trade on Bitcoin. The best thing to do is wait for price action to develop. Look for potential short-term entries, either to the upside or downside from support or resistance, and then try to be set up for when the actual move does happen. So keep in mind that nothing in this video took into account any fundamentals or anything like that. This is just the technicals based off the chart. And while some of these numbers are pretty close on the spot market as well, there are some small differences that are worth note. So right now, we're not going to get into crazy fantasies about where Bitcoin could be headed if we do go back into a new bull market, or where it's going to be headed if we do end up in some dread scenario where we break down and start losing key support. But we know some key levels to look out for, some resistance, some support, and we have lots of confluence between not only the moving averages, also our Fibonacci's from both those swing lows as well. We have the futures gap down here. So there's lots of stuff all lining up at those key levels. Real quick before we call it, let's go ahead and flip over to our weekly chart and just take a look at this as well. This is very important also. While we see the 200 simple and exponential moving averages aren't formed back here, they have always acted as support in the past. So here, once we broke below them, they acted as resistance. We broke down to a new low, and now here we are testing them as well. So we tested the 200 simple and we're unable to get above it. We are in between currently on the weekly time frame, the 200 exponential and simple as well. So if we break down below that 22,850 level, we will lose the 200 exponential, and that's first sign of danger, although we do have the 8 and 21 below us also. If we break back up here and retest the highs at the 200 simple, or even break above that at 25,000, it's very likely that we do start looking at some of those higher targets. So in the meantime, we'll keep our eye on Bitcoin futures chart. If you did enjoy today's video, make sure to like and subscribe. Remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, I just want to talk about Bitcoin futures a bit. It's been a while since we did a little deep dive on it. And while it's mostly similarities to the Bitcoin spot market, there are some differences, and it's worth taking a look at what the boomers are doing. There's a lot of institutional money involved at this point in time, so it's worth having a look at what they're likely looking at as well. All right, well, that was fun. Good talk. Catch you later.